The next session is on commercial and rural banking. Mr. Rahul Shyam Shukla, who is the group head of the business. I welcome him on stage.
Good afternoon, everybody. I'm very conscious that I stand between now and lunch, so I'll try and basically wrap up very quickly so that we are not delayed. This is commercial and rural banking. We are going to just review a little bit as to what this group means and does. So if you see, this is a graphic that we borrowed, from last year, which is there were 6 groups, which existed in the bank, and they were all put together. And these groups basically, constitute commercial and rural banking. Now, you may come back and ask, saying, what is the common thread, between all of these, or was, I mean, sometimes in corporations, jobs get created, right? But the fact is that, there are 2 synergies in this business. One is, geography, because this is, largely semi-urban and rural focused. And the second is, there is a strategic synergy, because this is all, public sector, generator for the bank. And we said last year that, there were 2-3 principles, for us. Number one is, that we would be measured by, how much PSL we generate. We would be measured by growth and income that we generate. And since, I basically come from a corporate background, we wanted to bring, basically that discipline, and did we, basically do a good job on that or not, right? So if you take a look on the right-hand side, our asset growth rate last year was about 30%. Our pre-tax ROA, we basically said last year that it is going to be greater than 3%, so it was, greater than 3%. PSL to ANBC of our book, which is roughly about 6.5 lakh crore or so, is about 80%, greater than 80%. So it does generate, because PSL for the bank requirement is about 40%. There are many subcategories, and we'll touch upon that. This is a 100% self-funded book as of 31st March. I mean, this is what it is, and if you ask me, actually it should be frankly more, and that is where we need to basically keep pushing. And lastly, the gross NPA percentage was 1.5%. There is some factoid at the bottom, which is basically the 2-year CAGR growth rate of those corresponding businesses, and that is there. This presentation will be available, so I mean, that data is out there. The next slide is, what did we accomplish? And there are 2 pillars in which accomplishments have been put, is business and inclusion. We are the number 1 MSME lender. This is, numbers that basically get quoted, published, etc. Mid-corporate is, slightly more difficult, because, but basis our understanding, that also we should be, number 1. We've been given a lot of, best SME bank awards, for the last, 2 to 3 years, whoever puts it out. Number 1 financier in the CV and CE space, commercial vehicle and construction equipment. We are the top, Vostro and remittance business that, basically folds somewhere. So this is all Indian migrant labor, who are sending, money back, about $100 billion or so. And we are very proud of the fact, because, there are very poor people who work in very difficult, conditions and send money back. So as we consume, $100 billion, of oil, these are the people who basically help us balance of payments. And we continue to, make sure and try that how can we make it, more easy for the poor guy, working in Jeddah somewhere, or in Qatar, Doha, to be able to send it money home for either education of children, or, basically things like just, buying sweets and clothes for, on the festival days. The bank today is self-sufficient in micro PSL and other PSL categories. So out of 40%, that is we have to meet, there are subcategories. So other PSL can't be more than 14.5%. So the bank is actually at about 19.5%. It's hugely surplus. And micro PSL, there again, the bank is hugely surplus, and we will talk about this. The right side is a lot of inclusion schemes, where we follow, the government. So we were the highest in ECLGS disbursement, and we are going to touch upon that in a later slide. CGT-MSC, I think a couple of weeks ago, we got an award that we were the best financing bank. We were the second in LGS CAS scheme. This was for COVID support in the hospitals, etc. I mean, that we're very proud of the fact that what we are doing. Number 1 achievement in the Agri Infra Fund campaign, and number 1 private bank in Stand Up India for women beneficiaries. But the way this slide is set up, this is not a ego statement, right? If you take a look at it, there is business and there is inclusion. And if you think about India, there are 2 pillars to basically the growth. A lot of you publish research reports that this is our decade, right? I believe that this is our decade, but my reasons are very different. My reasons are because that piece on MSME, that provides 60% of jobs in the country, and this piece, which is rural and agri, which is where 60% of the people stay in our country. Whatever government it may be, they're going to, basically focus on the MSME segment, and they're going to focus on the agri segment. And so instead of navel gazing, saying, can we do, can we not do, you have to go to the ground, and it is not, that difficult. These are very good businesses, and if you go along with government, you basically go into the growth path. So 5 years ago, when we said, okay, we want to be, dominant in MSME, today, it is a massive, basically profit contributor. And the same thing, it's my belief that in 5-year time frame, agri will be the hottest thing in this country, because we are moving away from pre-crop financing, which is working capital, to fixed asset creation. Everything is focused on high income generation for the farmer in the rural segment and creation of more jobs. And so that is, basically the point of this slide. The next slide, if I went, so there are 3 goals which we set out last year, and I will just provide you like a report card as to how we've done. The first is PSL. So if you think about it, the bank basically does some organic PSL, and then the bank goes out and buys certain instruments which are all RBI approved in the marketplace, right? So the top slide in March 21, basically our total PSL, organic and basically market instruments, was 40%, but the organic PSL was 30%, right? March 22, our organic PSL was 33%, and March 23, our organic PSL was 36%. Obviously, the total PSL was much higher. But how did we, basically continue to, keep jumping, moving towards self-sufficiency on the 40% overall PSL requirement? That is in the bottom. So if you look at FY21, if the bank put 100 rupees of incremental asset, 33 rupees was PSL. Next year, if the bank put 100 rupees, 36 was PSL. And last year, which is FY23, on 100 rupee of incremental assets, the bank put 60% PSL. Now, if you think about it, every year, that amount that we are growing is increasing. The growth rate may be similar, but the amounts are increasing. So that 60% is a huge jump. Now, one of the drivers of this is CRB, because if you look at our PSL to ANBC, that is greater than 80%. And the second is that in CRB, if we put, you've seen our growth rates on 100 rupees of incremental asset, 75 rupees plus was PSL, which continues to drive our overall PSL requirement further. So the bank takes it very seriously. This division was formed 2 years ago with that intent that Sashi must have thought about, and we are delivering on that. The next goal is growth and income. If you take on the left-hand side, 1st May 21 is, when the bank was created. And if you look at, all the YOY growth rates after that for every quarter that we've put is 25%, 27, 30, 30, approximately 30%, right? If you go back, look back these divisions and combine it, 2 years prior to the creation, that was about 15%. So, the growth rate on a larger scale is doubled. Now, think about, PSL. Many people may say, look, PSL is loss-making, or, it creates NPA. Or they may think that, look, these are, banks are buying, it's like a tax. And so, therefore, basically it depresses earnings. But that, is a myth, because on the right-hand side, we basically show you ROA. Now, we don't disclose, the numbers. We've only given greater than 3%, pre-tax ROA. So that 3% pre-tax ROA is, the solid blue line. The red line is where we were last year, which was significantly above the 3%. And each individual business is either at 3% or significantly higher than 3%. So if you go back and look, PSL is a requirement. It's a requirement, for banks, but it's a requirement for the country to go out deeper into, the economy and push credit. Number 2, basically, if you grow, it is not, basically adding, pain. It is actually earnings accretive rather than being, dilutive. This is, basically what the bank is pursuing. The third goal is, sustainability, which is NPA management, right? This group, if you look at from March 19, to March 23, the total CRB, GNPA was 2.17% in March 19, and it's 1.52% as of March 23. And excluding agri, it was 1.6, which is down to 1.08%. Now, when ECLGS happened, we were, quite bullish, and we basically put out, because our belief was that this was a way of giving 20 to 30% incremental credit to our customers without them having to pony up, incremental collateral. right? That is what it was. There was a lot of talk, chatter at that point of time saying, look, I mean, this could be to, window dress balance sheets, etc. Now the ECLGS effect in the economy is wearing off. So you look at, the bottom part of the slide. This is, a bureau data, which we are using, and we've taken out the numbers. So these 4 lines are, from the bureau. So the top red line is basically the GNPA levels of public sector banks. Then you have a light blue, which is NBFCs. Then you have this piece, which is industry, and you have private sector banks, and this is HDFC Bank, right? Now, see what is happening. September 22 to December 22, private sector banks at that point of time was 7%, and this is roughly about 9.8%. Now, 2 things are happening in the economy, right? One is ECLGS effect is wearing off, right? And so at that point of time, you will be seen for what was the purpose that you did ECLGS for. And the second thing is, you would have seen a lot of banks go out and build up, very granular portfolio on the 10 lakh, 20 lakh credit, etc., who are now moving to the larger side. Why is that happening? It's because, at that level, the delinquencies have been higher than anticipated, and so they're trying to, basically balance out the books. Now, we have a, basically balanced portfolio from small to large, and we see this, and we basically take a measured call as to how we do business, because we have to do all that business, and HDFC Bank, remains at that same level that we were. So this is, basically a attestation of, quality of our book, and I must tell you that the biggest, basically validation of our strategy in terms of how we extend credit in MSME is May 2020. That was a month in which the capacity utilization in the SME segment was 13%. And when it is 13% and you come out completely unscathed on your book without any, basically increase or a blip, on your GNPA, it gives you confidence that you are in the right path. And there is still lots to do, because out of 6.5 crore MSMEs in the country, only about 1.5 to 1.6 crore are in, the formal banking system, and there is just lots, more to come. How are we going to, so now let's go sector-specific, strategies, 2-3, large segments of CRB. One is MSME. How are we going to perpetuate a market leadership? So we are largest, we have a high market share. The way we built it out was on the left-hand side is that we continue to expand our footprint. So our ECG cities, footprint from 128, is 284. Those many cities we are. And our BBG and EEG, which is wholesale SME and retail SME, we today operate in 688 districts. And for those, who know or may not know, there are only about 730 or 735 districts in the country. And 688 district presence and lending on MSME is the largest footprint in the country by any bank. On the right-hand side, we don't only look at, basically being number 1 in India, because it's not a, uniform geographical marks. So you basically will see states. The deep blue is where we are number 1. So Rajasthan, we are number 1. Uttar Pradesh, we are number 1. Tamil Nadu, there are about 13 states where we are number 1. And the second, lighter blue is about 2 states where we are number 2. There are 5 states about where we are number 3. And then there are others which we are doing, very well. There are states where we used to have, be number 15. Now we are at number 8, etc. So that is what we are doing. But this task is also almost done, because the momentum is, carrying you through. Now we are looking at districts. So let me tell you that there are about 200 districts in which our market share in MSME is less than 5%. And there are further 200, districts where our market share is between 5 to 10%. And naturally, we are basically focused on that. So we don't look at this business as a broad brush that we are number 1. We have to, continue to do what we've done. Last year, we had said that we will do 1 plus 1 in terms of disbursement, that whatever was our outstanding, we are going to do the same amount of disbursement. Frankly, it was a very ambitious task. I think, Rahul, you had asked, what will happen. And I must have said that, you do sensitivity. Maybe I will do 110 or I may do 75. Either way, the result will be very good. But we actually did 116. And this year, our task is doubling the number of customers from FY22 level. So whatever was the FY22, we basically added, some customers in FY23, and then we are going to add more. So at the end of the year, between FY22 and 24, we will be 2x, basically the number of customers, which is what we are executing the second part of our 1+1 plan. This is our market share in between March 21 and 23. If you look at our market share, that was 12% on 2,06,000 crore. It was 18.5% on March 23 on 3,63,000 crore. So 50% increase in basically the market share, 32.7% CAGR in terms of growth rate in the MSME business, and broadly everything is the same. The best thing about this business is that we don't have to think of new strategy. We just have to continue to do what we are doing, and which is what we are going ahead. The next slide is, this is just, there is only one factoid of note, because we said that, look, we have branches. Most of the branches do MSME business, but there were only 2,353 last year, we said, branches where MSME proportion of their asset book was more than 25%. This year, as of March 23, 3,364 branches, so 1,000 more branches have been converted to greater than 25% share of MSME in their asset book, right? So this is a simple execution that we will continue to be on. The next piece is agri. This is, I think, the most exciting piece, which basically keeps me most interested in my job. And I think in the next 5 years, this is going to be, basically the biggest, wallet generator for banks. We have a lot of things. I mean, if you would have seen, this presentation last year, when I was reviewing, I thought that we had put out, something very rudimentary. And now when I look at it, and maybe next year again, I'll feel about this presentation being rudimentary. But we are doing a whole spectrum of things around dairy, because do you know that the largest agri product in the country is dairy? It is not basically grains. And then after dairy, it is still not wheat and rice. It is horticulture, fruits and vegetables, right? That is what it is. So we have product programs across everything. And at the end of the day, the bank has become very confident today that, look, fine, I understand that if there is a rice farmer, on 1 acre, they are generating 25,000 rupees a year. On sugarcane, they are generating 40,000 rupees a year. So we have to look at other income possibilities when we are doing lending. But somebody who's growing banana is basically on an average making 5 lakh rupees per acre per year, and it becomes financeable. So you have to look at different segments, and we have to approach it directly and indirectly. And we have a goal that in basically the next couple of years, there is that agri piece on PSL book, Suresh. There is 10% of SMF and 8% of other agri. That 8%, the bank is going to become self-sufficient, and that is what, we are working towards. Small and marginal farmer is something that we continue to work. There are 10.5 crore, farmers. About 6 crore do not get any formal bank finance, and we are working on substantially increasing the number of farmers that we bank, and we have a 5-year plan on that. On the right side is, last year we said that we are going to increase our footprint on villages. And by FY24, we had said that we will be in 2 lakh villages. Today, we can say, give an update that, look, we are targeting to be in 2.25 lakh villages, because on our glide path, we are at 1,65,000 already. In 2 years, we've increased our footprint from 99,000 to, this particular number, and we will continue to increase. And this is, what we are following. It is, in a sense, very similar to our MSME strategy. It's a proven strategy, and we basically are pretty excited about that. The next slide is just our industry market share in KCC industry. So we'd said last year that, we would be by FY24 at 9% market share. And if you want to measure that, March 23 data from bureaus are not out as yet. But look at, December. So those, show a very good path that until March 22, we've done well, and we are at 6.86. But if you look at, December figures between 2020, 21 and 22, 5.8 increased to 6.4% and increased to 7.29%. I think when the March data comes out, we would be somewhere between 7.5% and 8%. So we are on track to get to that 9%, which is quite important. The next slide is about our transportation business. And this is again, there is a logistics revolution going on in the country. And the way I see it is that there are 3 components of the business. Today, there is a certain type of equipment that we go out and finance, right? The excavators or the MHCV, etc. But that is only about 10 to 15% of the market. And by doing that, we are number one in, basically the marketplace. We are bigger than everybody, including NBFCs. So there are other equipment business where we are not penetrated, where we are now putting a focus, and the non-equipment business, which is the OPEX piece, that is also a focus. Now, the synergy around all this is that we have strong OEM relationships. Today, most OEMs of note, who basically do business, we would have about 30 to 40% of share of financing, for them. Our share of their equipment sales financing is higher than their captive NBFCs. So obviously, relationship is strong. These three segments are in overlapping geography, which is where we are, and it's not very difficult. Transportation and logistics business is about 50 different cities in which you have to be in. You don't have to be in, 225,000 villages. So you can do all that, from the existing footprint. It has a similar distribution channel and common customer base. The customer who's buying a new equipment is also, buying used equipment. So think about it. Number one is fine. But my view is that, should this business, which is, if you say today is 1x, should it not be greater than 3x, right? And that is the execution, path we are on. We are not, basically looking at this 15, 20, 25%, over a 5-year period, if you're looking at it, we are looking at a step change completely in this business. So today, the ROAs are very strong, the growth rates are very strong, they've opened up, in this particular year, very strong, but still that is not, we are not doing justice to ourselves and our, distribution footprint if we just continue to show, 25, 30% growth rate, that is useless. The next slide is digital. Now, I read one research analyst report that they compared, the digital disclosures of different banks across different quarters, and they came out with a conclusion that, basically it is very difficult to make sense of it all, right? So I'm just trying to, basically put the end goal, right, of this. What do, basically in CRB the digital means? One is the originations and logins, right? The originations and logins. The second is the credit underwriting piece. The third is the documentation and disbursement. And the fourth is the client self-service. Today, origination and login, 90% is fully digital in CRB, right? 90%. Now, you can say, why is it not 95%? Why it is not 100%? I can take, the criticism. It's 90%. Now, you think about it, 90% digital, doesn't mean that you're scanning and, basically sending it out. Or, maybe the formats may be, much better, or the user interface may be better, and that is a continuous evolution that you keep doing. But that 90%, gives you the beachhead to continue to build upon. Documentation and disbursement, which we are measuring, 75% is, completely digital, which includes, by the way, mortgage creation in states where it is possible to do, or perfecting, security on cattle finance in certain states where it is possible to do. So that 75% is a very high number. When you compare our digital, go out and get this data from any bank, because you would not have seen this data. Self-service capabilities for clients is 100%. Of course, client, if the bank branch is opposite, they will come back and say or call somebody. That happens, but that is 100% capability. The middle piece is the credit underwriting, where we continue to keep pushing, right? We continue to. We are not at 100%, we are not at 50%, it is lower, but this is a journey that you have to go through. Now, why are we doing, all this, right? Because at the end of the day, where the economy is headed, say, for example, in ONDC, it is going to be a T4 layer lending. You are not going to originate and collect yourself, that is T1. You're not going to originate yourself and have somebody else collect, that is T2. You're not going to basically have somebody else originate and you collect, that's T3. But here will be that, somebody is originating, somebody is collecting. You are just in the middle, looking at the cash flows and the history, and you're providing financing. If you do not perfect, this entire piece, you will come out a cropper 5 years down the road. I won't be standing, at that point of time doing this presentation, because my firm would have, fired me by then. So we are basically building for a future. It is not about, basically today. These are the 4 parameters that you should measure. Lastly, in conclusion, the last slide, last year we said we have 1+1 for disbursement, then for customers, and in the third year, our income is going to double in CRB, that is FY25, we will be 2x. we are going to happy to provide basically another estimate that between FY23 and 26 that will double again, and that is what it is. Thank you. I'm open to taking any questions, sir.
So you're saying the core financing is gone, core PSL has gone from 30 to 38, right, in the last 3 years. Why go to 46? What's the logic? I mean, why are you buying 8%?
No.
You can be at 42.
No. So PSL is very complex. So you have to achieve 40%. That is number one, right? In case you are basically short in certain categories like agri or SMF, then you have to go out and basically cover those individual sub-segment shortfalls. 40% is not good enough. Out of 40%, 19.5 or 19.7% is my share of MSME, but I can't count more than 14.5%, so I can sell it in the marketplace, right? Micro, where you have a 7.5% requirement, 3 years ago we used to be 5.5%, today we are at 9.5%. So we are in a position to go out and sell it, right? But the other pieces you have to go out and cover. So you have to buy PSLC, you have to do IBPC, you may do other instruments, and if you still have a shortfall, you have to go out and put money in RIDF, which is very low NIM. So you have to work through each sub-segment. So today the bank is not giving you a overarching 40%. It's telling you that where it is short and what it is working on. So 3 pieces are completely licked. Only piece left is SMF, and if you do SMF, there is a floating requirement of 12% of weaker section above all this on 40%, and that also gets met if you are able to get your small and marginal farmer strategy right. So that is where I mean we may have an excess, but as you continue to grow at 36-37%, we don't need to go out and do that excess and pull it down, because some of those investments may be earnings dilutive, and so that's the path on which the bank is on. Suresh, let me tell you this. I don't know whether it's appropriate or not, but the fact is that as banks grow bigger, their shortfall, any bank would be high, and they will all go through a similar cycle. Your bank, basically at least has taken that proactive step. Nobody can talk today about 1,65,000 villages or 688 districts. So my friend, 688 is giving me 19.5% and 9.5% on micro and this thing, and agri also we are basically solving.
As you keep growing, you can meet these segments and bring down that 46%, right?
Absolutely. Then you are at 40%.
Yeah. So in this background of this fantastic presentation that you have done with respect to the growth prospect, the fact that you are now going to go through a merger and you have got a good extension of timeline, theoretically speaking, all the way to December 2026 on the merge, the balance sheet of HDFC Limited, does that mean that you can deliver to Sashi that entire requirement without needing to go to the PSL?
So somebody during the break asked me the question that now that you have got a dispensation, will CRB not grow? Because as though we were growing only to meet the requirement, and my answer to that is that it's the highest growth rate business and the highest ROA business in the bank. So why would it not grow, right? I mean obviously, but all of that capital allocation is an ALCO decision, which is what we go out and do. Look, the merger is not yet effective, right? And there's an integration committee which is basically planning all of these things. Once the merger is basically effected, after that we will basically go out and talk about how we are looking at our PSL roadmap, which Srini may have given you some guidance, but that is post that. But we are in a good position. I mean, look, you have to build. This cannot be built overnight. I don't know. I mean, 2 years ago when CRB was formed, at that point of time, maybe the merger was not even in the horizon or in people's minds. But it is good that it was created, because this, is a virtuous cycle that you will go through, which will keep strengthening. So puts us in a good, basically position. Whether we will be, fully self-sufficient or not, there will be many segments that we will be fully self-sufficient. But all the segments, I mean, today also we are not.
First of all, congratulations for the presentation. First question is on the runway for growth. Of course, you've talked about 1+1 and next year, and even the TFG. But the slide that you've shown about, how the market in general, excluding HDFC, has been doing on MSME in terms of delinquencies, NPL, etc. And squaring with, Sashi's comments in the morning that MSME does have some segments of, problem, particularly maybe the lower end or whatever it is. Does it give you comfort to keep growing at this rate, even though the marketplace or your competitors are having some problems out there?
So, let me answer that. Otherwise, if you ask all the three in old age, I may forget, the other two. So let me address this. So for us, the litmus test was 2020 May, 13%. So we are confident about that. The next litmus test that is happening right now, this financial year. This financial year, if a bank comes back and tells you that utilizations in MSME are high, you should be very worried. It's an election year phenomenon where consumption picks up and cash flows are released and outstandings are going to be depressed. So my team came and said, sir, our outstandings are low, what should we do? I said, feel good about it. Outstandings low means, your book is good. Now, I can't say what other banks do and what we do, but it's a trend over the last, 5 years that you've seen. We've had learnings and we fine-tuned. We do not believe that, that is the case. Let me tell you this. If you take, I was looking at a bureau data, that if you look at our originations on new to credit, basically our delinquencies are very low. 90 plus DPD is about 20 basis points. And if you combine all the 6 banks after us, their delinquency was, about 50 basis points, which is also not very high. Not very high. But step back and think about it. My question always is that, are we taking enough risk? Or are we assuming that there are risks when there aren't risks? Because today, the amount of cash flow visibility is immense, right? Any bad borrower gets called out, basically their bureau, standing, etc., which also is there. So people are quite alert and aware, to that fact. Earlier, if you remember, 10 years ago, there used to be all these products in which farmers used to get categorized as, having taken loans when they didn't know, right? And those were, corporate tie-ups, etc. And today, they are all very alert because people want to keep, their credit scores completely clean. So I don't, feel or believe that, there is basically a hurdle, and that, it should allow us to continue to grow. And this year is again going to be that, health check. Just ask everybody, how's your utilization? Anybody says, utilization has increased, be very careful then in writing a your research report on them.
Yeah, that's helpful. The second question was around the ROA trajectory. So now you're talking about, further increasing the throughputs in some of the business like TFG, etc. Do you see further scope in ROAs going up for your business?
So ROA is, there's only one way of looking at it. So we've given you greater than 3%, right? That is a long term, that you should expect. Now, what happens in a tight, basically money cycle or high interest rate cycle? Deposit costs, do go up, it catches up, and ROA moderates. And then, when you have the next cycle of, increase at that point of time, because the lending rates increase faster than, the deposit rates, you have ROAs go up. So don't look at ROA as 1 year phenomenon, you look at that, and I think, we feel comfortable that that threshold that we've given is, basically good enough. I would have liked to, give a higher threshold, but Srini, pulled me back saying, no, just stick with this.
No, the reason I asked was because of the operating efficiency that could have been pretty significant, growing within the same segment. Like you talked about TFG, some of the equipment business which can be done out of only 60 cities, etc., from your existing network. So as the book size becomes larger, naturally you'll have the operating efficiency.
It's possible. Yes, TFG, basically has had a significant improvement, in that pre-tax ROA that we've seen over the last, couple of years. What you say is, definitely possible. But I wouldn't, want to basically comment. We will see as we go, if we need to update, any of these thresholds, Rahul.
Just one last question, a small one, and I was just thinking about the coverage of the book under any kind of a guarantee program, be it CGT, MSC or ECLGS. Can you give some color around what proportion of the book is covered by these 2 or 3 government-run programs?
I'm not going to give a percentage, but today, when you sit down, with basically at central government in any ministry level, they will ask you a question: what is your contribution in street vendor scheme? What's your contribution in Stand Up India? And these are not bad schemes. These are not bad schemes. If you go out and give a loan to a lady in, a village around, Jhansi, and she takes 40,000 rupees and she buys a buffalo to basically sell more milk, it's not bad because the dairies are buying, that. Now, what enables me to do the lending is, using one of, the government guarantees. So, you see the firms, basically risk framework remains the same. What was 5 years ago, what was 10 years ago, what was 20 years ago. You should expect no change in that. Now, what we've basically done is that, look, there are areas that we may not know enough or we may not be comfortable ab initio, then go out and see if there is a, wrap available. The wrap also has to be responsibly used, because suddenly if you start claiming too much, someone is going to come back and say, hey, can I diligence, how you gave that loan? Right? So that the bank is very mindful of. You're the second largest bank. You have to play, that role in, the economy at the end of the day. Gone are the days that, we will do only so much, or we will do indirect means of, doing PSL, and, that is fine, because that is not an option anymore. And the good thing is that we've learned, that doing that is not dilutive. It is, accretive on ROA and earnings. So that's good. So let me put it this way, that if I go out and say that open a branch for me because I need it, that's never the right corporate strategy. The corporate has to take a decision where, the branches make sense. And it's an independent process, basically, it's driven by retail branch banking. They will take inputs from Nirav, they'll take inputs from me, they may take, inputs from Arvind Kapil, and we will all give saying, hey, this is where we need. If you ask my team, they will say, we need 25,000 branches, across villages. And I say, look, 25, how? I mean, just compare 25,000, rural branches. Why do you need it? Even State Bank of India doesn't have it, and they do a fantastic job in terms of, basically rural, priority sector requirement meeting, right? So we give our inputs, and then, the bank has a method through which, it comes out.
And in terms of your ROA,
because the branch break even and profitability is not my responsibility, right? I contribute, but somebody owns it. So the owner has to decide, whether it makes sense for them to open or not. I can keep hustle, all the time, but that's all. That's where we stop.
So that, leads on to, of the ROA, how much of that corporate cost is passed on to you and visible in that 3% ROA, or is it more marginal in nature? Like, do you get hit with everything that center can think of hitting you?
Yes, I get the question. So it's basically any corporate will have allocations, right? Because at the end of the day, there is zero sum, which stays somewhere else with MD or with treasury.
That is the case at HDFC.
So now none of those transfer pricings at any point of time will be perfect, but the firm follows a particular thing. So this is a fully loaded pre-tax ROA.
Thank you.
Rahul, over here. I have a question over here.
Yes.
So you are a god of PSL, obviously, for the bank. If you look at your SFR ratio, which is self-funding ratio, which I think in one of the slides you mentioned about 100% in the commercial banking space. That's like, I think, a very good ratio that you have. One, how do you achieve that? Where do you want to take it forward? Because I think bank will need a lot of deposits as well going forward. And when you calculate this SFR ratio, basically, does it only includes deposits, or there is other elements of business also which gets into that SFR calculation? Third is the question again related to that, is that because of the higher SFR, is your basically your NPAs are lower in the CRB business, and because of which your ROAs are higher?
I'll answer those two questions first. So let me tell you about self-funding ratio. Today we target that for every farmer we should have 2 savings accounts, for the Mr. Farmer and Mrs. Farmer, right? And secondly, we basically target that, look, there should be at least 2,500 rupee of balances in those savings accounts. But now we are pushing, saying, look, there should be DBT linkage, because DBT comes, from the center. So if you go back 1 year, about not all the farmers, basically had those 2 accounts. Today, everybody has 2 accounts. Not all of them have, 2,500 rupee balance. And last year, if I was standing at this point of time, I would have said that the DBT linkage, where the DBT, benefits were coming, was 15%. And today, as of March, I think it is about 65%. Our goal is to take it to 95%. Right? So when you think about it, I will always be a believer that there is far more potential. For every SME business, they don't just have one business. They must be having at least 5 or 6 businesses, which is, 5 or 6 current accounts. And the extended family, if you start, adding up with everybody, because there will be a businessman in Guwahati whose son would be married to, someone's daughter who's a client of ours in Belgaum, right? Who may have, basically an aunt who lives in Nagpur. So when you start, basically adding up, looking at all these businesses and connecting the dots, I think, there is far more potential, far more potential. I don't want to go out and, basically go out and, throw a dart and fix a number. But this is what, we would like to. And beyond 100%, what do you want? Yeah, are you not happy with it? It's good, na?
Yeah, but I think going forward, the bank needs.
Yeah, so the bank needs, obviously the bank will manage liquidity, and if we have to do more, we'll do more, or if we have to do less assets because we are okay on PSL, that also is an option. The second thing is on GNPA, right? There are 2 things we've always said how we do this business, right? 3 things. First is customer selection, right? And so I think we do a good job of it, that is why the results are what it is. The second is, the collateral cover, which we monitor, and not any collateral, because plant and machinery and inventory, if you exclude that, we are looking at hard collateral, and so that, has to be healthy. And the third is self-funding. Now, all self-funding cannot be appropriated, because, there are rules that may not belong to, basically the business, it may be to the family, and at the end of the day, while, the gap between the personal and the professional in the segment is very porous, thin, but still there are rules that govern it. So you can't go out and appropriate, but the movement of the cash basically tells you what is happening. So May 2020, I go back, that is when we saw that, the savings accounts were getting depleted and people were paying down, their loans, saying, why should I, continue? It was a good, happy thing. So balances went down, but so did loans, right? because the capacity utilization was so low. So we have believed this, we will continue to believe it, because it has stood the test of time, this thing, the way we think about it.
So SFR also does plays a big role in terms of your NPS being lower.
Of course, we are not a plain asset business. There is only one piece of the business where, I think there is a DSA involved, which is the commercial vehicle financing, and that is, I think, sort of low to mid-teens maybe. But if I had my way, I would have it, basically 0, because the moment you, basically you pull asset in that fashion, then you're running an asset-only business and you're not running a banking business. So the focus is, 360-degree banking, and, which is why the results are what they are.
And what's the share of the non-fund or a non-balance sheet business in the overall commercial revenue?
It depends business to business. SME, it is there. It is going to increase as SMEs, start basically selling to the Middle East in rupee-denominated, Vostro initiative of the government of India, etc. So we will have to, provide guarantees. I think it is higher in the infrastructure, finance business, because, there, but it is backed by fixed deposits, so, that also generates. So it's a business to business.
Thank you.
In the agri, business, we have, 4.25 kind of a gross NPA number, and which is better than second largest, private bank. But the kind of growth that we are planning to have in the segment, so like,
Sure.
how we are going to go ahead with this number. Though we have come down from the gross NPA number point of view on a quarter-on-quarter basis, but on a falling quantum.
Yeah. So let me just share this, because we went through this, entire debate and education, and everybody had to, basically come onto the same page. The total agricultural produce in this country that happens is about 35 to 40 lakh crore. That is the value of all agriculture that we produce in this country, right? If you split it, what comes from large and mid-sized farmers, where, you should have less, because they are almost like the smaller MSMEs, right? That is about 50%. We have a good share of that, right? That's no problem. But you need to meet SMF, and what is the small and marginal farmers' contribution? That is about 50%. So 17.5 to 20 lakh crore. Let's just take by ballpark, 20 lakh crore. Now SMF, when you give lending, below 1.5 lakh rupees, that has to be unsecured. When you can't take security of the land, you can take security of, gold or something else, right? So that 50% is produced by small and marginal farmers. Now, in that 20 lakh crore, there is another split. 5 lakh crore is cereal, which is wheat and rice, which is, and low per acre basically income. And 75%, which is 15 lakh crore, is these value added fruits, vegetables, etc., where the yield per acre per annum is 5 lakh rupees or so. So you have to step back and see what you're doing, where you're doing. The second thing is that, okay, you can think about pre-crop financing only, but you can go out today. There is a government push for fixed asset creation. So under Agri Infra Fund, drones, there is a subvention, and you basically can go out with government guarantee, 10-year loan, or the 30,000 square feet warehouses that individuals can go out and create and store their goods. So that is basically the second piece. So there you have full security, and you're going out and basically doing that. So it is a different business because the nature of credit in agri is completely changing. The third thing is that if you're not comfortable even on basically pre and post crop financing, the ability of farmer to hold so that they don't have to sell at distress when the harvest is done. Today there are with warehouses they can do pledge financing. We are the largest player in pledge financing because you take the goods under your lock and key and you can sell it. But that allows the farmer to hold it for a couple of months, and then they go out and sell. So that is a fantastic change that is happening in the economy at this point of time. So you look at, basically at the ground level, many things are happening. Now, you think about a farmer today. Do you think, basically a farmer with 1 or 2 acres is running a family with only 25,000-50,000 rupee income per annum because he or she is growing, rice? No. Because every farmer, there is one lady, who will be working in Anganwadi. There will be somebody who will be working in the local school. Even, if you're tolling the bell at every hour, their salary is about 25,000 to 35,000 rupees per month. And all of them, will have a shop in the local market. So the combined income is something that you have to look at, the non-agricultural income also in terms of cash flows before you go out and take a decision. The thing that, basically gets this thing, we have to progress as a country, right? We talk about $5 trillion economy, we talk about $10 trillion economy. How can we become that if we leave a segment behind on notions which may not be correct? We can't, right? So you have to go back and, provide. There is a UK-based, very respectable, magazine who wanted to know what is happening on street vendor scheme, and, we said, okay, you can go out and see if there is, because there is a Pradhan Mantri scheme. He went to Varanasi, he spoke to one guy, and so the guy, he asked the guy, did you get, the loan from the bank? Yes, I got, 10,000 rupees. What did you do with the 10,000 rupees? Because this guy was making puri and sabji in the morning for breakfast. He said, my son has, basically started another stall, right? Income is coming. When I went, to Lucknow, there was somebody who came from Sultanpur, who basically said, sir, I went to every bank and nobody gave me loan. There was a government scheme available under which wrap you could give a loan, and he started producing mentha oil. That guy today earns 15 to 20 lakh rupees a year, right? Obviously, there is, so first is we have to remove the notion that this is, basically high NPA. Have you looked at district cooperative banks, balance sheets? Their NPAs are better than, basically large banks' balance sheets. Go and take a look at that. So that is, number one piece that I say. And the second thing is, we work in India, we operate under the laws of India, we have to meet, the priority sector guidelines. So you got to do it, no? And let me tell you, in a few years, you will basically see that this is not earnings dilutive. In fact, it adds to the earnings. This is the biggest profit pool, in my belief, that is going to happen in this economy. The transformation that is happening at the grassroots level in the country. Sorry, this always gets some emotion out of me. Thank you.